So you watch the videos. You're ready. Open a Roth IRA, buy VOO, retire rich. You log into your European broker, type it in, and get this, not a glitch, not your broker being difficult. It's the law, and it's just the first of 5 ways American investing advice quietly breaks the moment it crosses the Atlantic. Here are the 5 differences every European investor needs to understand, including number 3, that can cost you or save you thousands in tax, depending on which side of a border you live on. Difference 1, the accounts. Almost every American video starts with the same 2 words, retirement account. 401k, Roth IRA, boxes where investments grow tax-free. That advice assumes the box exists. In most of Europe, it doesn't, at least not in that shape. Instead, Europe is a patchwork. The UK has the ISA, £20,000 a year, tax-free. France has the PEA. Sweden has the ISK, taxed in a completely different way, a small flat annual charge instead of tax on gains. Switzerland has Pillar 3A. And a long list of countries, including most of Central and Eastern Europe, has essentially nothing like it. There, you invest through a plain brokerage account, and your country's tax rules decide what happens. There is a pan-European pension product on paper. It's called PEP, and across the entire European Union, exactly 2 companies offer it today. So the first translation rule is this. In America, the account does the tax planning for you. In Europe, the country does, which means step 1 is never open this account. It's learn your country's rules. Keep that in mind, because it comes back with a vengeance in difference 3. Difference 2, the funds themselves. That error message from the beginning has a name, PRIIPs. Since 2018, an EU regulation says every investment product sold to retail investors needs a standardized key information document. American fund providers don't produce them. They have no reason to. No document, no sale. Which is why VOO, VTI, SBY, and QQQ are simply off the menu for European retail investors. The good news, Europe built its own versions. They're called UCITS funds, same indexes, same companies inside, wrapped under European rules. The S&P 500, Vanguard and iShares both run UCITS versions. The whole world in one fund? That exists too. We'll decode those cryptic ticker names in another video, link below. And here's the part almost nobody tells you. The European version can actually be better. Most UCITS funds are domiciled in Ireland, and thanks to a US-Ireland tax treaty, they lose only 15% of American dividends to withholding tax instead of up to 30%. Not a downgrade. A different, sometimes smarter, wrapper. Difference 3, and this is the expensive one. American advice lives in a world with one federal system. Hold longer than a year, pay the long-term rate. Simple. Europe, there is no European capital gains tax. There are dozens of national ones, and they disagree wildly. At one end, Denmark taxes share income at up to 42%. At the other end, several countries charge 0, some immediately under conditions, some after you've held long enough. Slovakia after 1 year, Czechia after 3. Slovenia starts at 25% and steps down to 0 after 15 years of holding. Germany does something Americans would find bizarre. A small annual tax on gains you haven't even realized yet. Ireland goes further. Every 8 years it taxes your fund as if you had sold it, at 38%, even if you didn't sell a single share. Same fund, same holding period, one border apart, completely different outcome. Which means the most dangerous sentence in European investing is, my friend said, your friend lives under different rules. This channel will unpack these country traps one by one in a series we're calling Money Traps of Europe. Germany's phantom gains tax is first in line. Difference 4, protection. American videos love this line. Your broker account is insured up to $500,000. Then a European Googles their own protection and finds 20,000 euros. Cue panic. Let's calm that down, because these numbers don't mean what most people think. Under European rules, your securities are not the broker's property. They're held separately, legally yours, sitting apart from the broker's own money. If the broker collapses, your ETFs don't go down with it. As a rule, they get transferred. That €20,000 compensation scheme is a backstop for the ugly scenario fraud, missing assets, not the everyday one. And your cash in a bank? That's a different scheme entirely, €100,000 per bank, per person, EU-wide. Deposits and securities, 2 systems, 2 numbers, and mixing them up is how scary headlines get written. The full broker bankruptcy story, what actually happens, step by step, is coming in its own video. Difference 5, currency. An American earns dollars, invests dollars, retires in dollars. You earn euros or forints or zloty and buy a fund that prices in dollars, holding companies that earn in 50 currencies. 3 different layers. The currency a fund trades in, the currency it reports in, and the currencies it's actually exposed to. Only the last one really matters long-term, but the first one can cost you real money in conversion fees every single time you buy, if your broker charges for it. And sometimes the currency layer rewrites the whole story. In 2022, the S&P 500 fell about 18% in dollars. For a euro investor, thanks to a surging dollar, the same index lost closer to 13. Same fund, different reality, because you don't live in dollars. So different accounts, your country, not your account, does the tax planning. Different funds, UCITS, not US tickers. Different taxes, check your border, not your friends. Different protection, separation first, compensation second. And a currency layer Americans never have to think about. Here's the thing though, the principles in those American videos are still right. Low costs, broad diversification, long horizon, boring consistency. The plumbing is what's different. And this channel exists to map the European plumbing, with sources on screen, no hype, and no trust me bro. Start with the one video everyone should watch first. What UCITS actually means, it's right here. This is educational content, not financial advice. See you there.